Okay, everyone, welcome to chapter number 4 in the Trading with Market and Volume Profile course. We're going to be talking here about auction market theory, or AMT for short. This is basically the foundations of how market profile is measured and how we analyze the interaction between buyers and sellers to find prices. We're also going to talk about balance and imbalance concepts, which is used a lot, as we're going to see, when we're talking about price consolidating or trending pretty much. So, auction market theory is a philosophy that financial markets move higher and lower due to imbalances between buyers and seller aggression until price discovers a level where aggression is balanced and the most trade can be facilitated. So that's what we would consider fair value. Okay, so when we see markets and they're trending sideways or chopping, that's what we would deem fair value areas, because we can see that buyers and sellers are mostly in agreement and the price is trending on a tight range. Whereas if we see trending markets or imbalance, then that would imply that sellers are overwhelming buyers or buyers are overwhelming sellers. Okay, one thing you're going to see used a lot is this right here, not just in market profile but also in volume profile. This is a standard bell curve distribution where basically we have the mean in the middle and then we have one standard deviation to each side, where if we add them both all together is going to be 68.26% of all data. So as we're going to see later when we talk about value area, fair value is the same as what we call value area, which if you've been following me for a while, you know it's a concept I talk about a lot when we talk about volume profile. And some platforms by default are going to have this value area at 70% because they just round it up. But I always like to use 68% just to be more exact. But, you know, the difference is pretty minimal, so don't stress out, you know, that 2% difference is going to make a huge difference in your results. It's all pretty much very close. There's 3 components in the auction market theory. We have price, which is an advertisement opportunity in the market. Obviously, you know, lower prices are going to attract more buyers. Higher prices are going to attract more sellers. Then there's time, which regulates the price opportunity. So, you know, if we have a market that is spending a lot of time at higher levels or higher prices, then that's time acceptance. And we can see that if it spends a lot of time at a certain area, it's most likely then that we're going to start finding balance and longer term acceptance there, for example. And then there's volume, which is the measures the success or failure of the auction. So if we have a market, you know, something that shoots up in price, but no one is really interested to buy it up here, and then you see just a very quick retracement down, well, you can see we spend very little time and we spend very little traded volume up in this area, meaning buyers were not really interested to buy or pay up at this prices, for example, and the market most likely is going to see a retracement. The volume measures the interaction of market participants at different price levels. Okay, so basically the market's job, we have 2 things. It's to first facilitate trade and serve as a place where buyers can put in bids and sellers can put in offers at the same time, you know, because as you know, markets are a zero-sum game. For every buyer, there's a seller and vice versa. And then the second job of the market is to help us again find fair value. Okay, so prices are too low, and they're below fair value, then the demand is going to press it upwards. When prices are above fair value, they're going to come down because there's going to have more supply or seller demand. So think of fair values, just like we see here, as the mean. And this can be any product or any market. This can be, I don't know, the S&P 500. And you can see there's going to be, for that session, let's say we have the volume profile or the market profile for this session, and there's going to be a value area with a mean, where that will be what we call the point of control, the place where we had the most time or trading activity. For example, we're going to go much more into this in detail later on. Okay, so a lot of times we see examples with cars. Let's just go over an example, let's say with a phone. Okay, so let's just say there's a new phone coming out and it has a base price of $1,000. Okay, so then the phone is launched, and there's going to be a little range. Let's say some people are selling it up to $1,100. Some retailers are down to like $900. But you see the phone is going to be pretty much trending between these ranges. Okay, so we're going to be filling in a value here. We're going to have the mean right around the middle, where the price, the most sought or sold price is at, and the most time acceptance for the price. But then there's going to be different factors in the markets that are going to affect how buyers and sellers behave. So let's say, for example, that there's a problem with the software of the phone and is not really performing well. The battery life is not very good. Well, that's going to cause then people to want to start selling, and sellers are going to overwhelm buyers. People are not going to really be interested to pay $1,000 on average for this anymore. And then let's say this goes down to $700, okay? But then the company, let's say they quickly release a software update that fixes the issue, and then suddenly, on this good news, buyers step in again, and then this is going to get pushed up. Okay, so now that it's coming up, now there's more buying interest. People are not interested now to be selling at these lower prices, and demand builds up. Then let's say they start a very aggressive campaign with influencers and just new features, and then that's going to create a lot more interest. Or especially, let's say, if they start getting, they don't have enough components to really ramp up production, so there's going to be a little scarcity, then that's really going to drive prices up. Because as you know, with low supply of any certain item, then that's going to drive prices up, because there's less available supply of products and people are still going to want it. So then buyers are going to be willing to pay up even more for that product, driving it up. And then, of course, once we're reaching higher levels, let's say 1,300, then now the sellers are going to be interested in selling for a nice profit right on this top prices, and buyers are going to be less and less interested to be getting in on this prices right at the highs. Okay, so as you can see, all markets function the same way. It's just an interaction between buyers and sellers, depending on how price, time, and volume are all interacting. So this is a diagram showing the basic relationship that we were talking about. We have a market that is in fair value, meaning it's balanced. So if we're looking at a chart, this is going to look like a market that is mostly trending in a tight range, sideways, or just chopping around a small area. And so demand is pretty similar to supply. This is what we would call an efficient market, because there is a lot of effective auction being facilitated and buyers and sellers are mostly in agreements about price. Then we have an imbalance. This is an inefficient move, and then this happens when we have a break from that balanced behavior and we start a trending environment. Okay, so in this case, either buyers are going to be bigger than sellers or sellers are going to be bigger than buyers. So in this case, we had this nice range with a resistance and a support, and then because of any reasoning, whether it's a fundamental news, etc., we're going to have a break of this support and we're going to start into an inefficient or imbalanced phase where we're going to be trending until prices eventually are going to settle and they're going to find a balance area again, and prices are going to start getting accepted in these areas. Okay, and then after this one, when we're in the process of imbalance, we have what we call price discovery. We're looking for a balance at fair price areas, okay? And this is a very common theme that we're going to be looking a lot in markets. So we can see, for example, in this diagram. So we have a market that's mostly trending sideways. Then we're in a balanced state. Then buyers are going to step in and push this market up. And remember too, we're going to talk later about market participants, but when it comes to markets, us retail traders, like smaller traders, we don't have the capacity to really move markets, unless it's some really unknown, weird market. But if we're talking about like NASDAQ, S&P 500, Bitcoin, Euro, US dollar, like really big liquid markets, retail traders are mostly going to be looking to latch onto trends, but it is big players like hedge funds, banks, investment firms, retirement funds, central banks, etc. These are going to be the institutions that are really going to be putting in those huge orders that are going to throw the markets into an imbalance or trending state. And that's going to be where we're going to try to identify those moves and latch onto those. And then with markets, as always, most on average, about 70 to 80% of the time, markets are going to be in balance, meaning they're going to be mostly trading sideways. So the trending opportunities are going to be less than what they're going to be not as prevalent as balanced environments. And once a market is in an imbalance, it's going to go up to an area where eventually is going to find a balance and acceptance again. And as we're going to see all throughout this course, most of the time, let's say this market was like here and we had something like this. Most of the times when we have an imbalance, market is going to come and basically is going to target a previous balance area. So it's going to seek previous areas where there was price and volume, time and volume build up. And usually that's where the markets are going to get sticky, and there's going to be more friction, and there's going to be more efficient trading between buyers and sellers at this fair values. And then the same thing. Another imbalance is going to come in, a new trend is going to start, and we're going to come down until we find again a balance in another previous area. Okay? And as we can see right here, for example, if we take this chart, I have a volume profile from this entire all these candlesticks here. This is the volume profile for this. And if I go into the next slide, you can see how we can identify the areas where market is mostly, as you can see, in a balanced state. Here we have a balanced state here, and this can be any market. I just took a screenshot. I don't even remember what market this was that I took a screenshot of, but you can go into any market or any time frame, and all the same behaviors are going to be observed on all of them. Then you can see you have a quick push down and imbalance, another balanced state, then we had a little trend here, a little consolidation upwards, then a sideways move, then another quick imbalance area, and then another balance area that we find here. And as we're going to see later on with this, if you see at the volume profile, one of the elements we're going to talk about later is what we call the high volume nodes. And basically in volume profile, the high volume nodes are going to be areas of balance. So you can see how these areas where this is sticking out, this is accumulated traded volumes, and it's going to be very similar with market profile. We're going to analyze how you normally would have this side by side, but you can see how these balance areas are going to be giving us this high volume node accumulations on the volume profiles, as well as in the market profiles too. Okay, so markets are estimated to spend 80% of the time in fair value. So that's what I was mentioning before, 70 to 80%, but probably closer to 80% of the time, markets are what we call consolidating, balancing at fair value. All these terms are pretty much interchangeable, but when there are attempts to break out of balance, so Stottlemyre, remember, this is one of the godfathers of market profile. He called for two types of activity when there's a move to try to break out of a balance. So you can see here we have, this is all various sessions of market profile. And you can see here, these areas between this orange lines, this is the value areas of this profile. So this is the fair values. This is 68% of the whole time that the market spent in this value area during this session. And what you can see here, we have first what's called responsive activity. This is the expected behavior, where if markets breaks below value, it is deemed cheap and buying is expected. When market breaks above value, it is expensive, quote, and selling is expected. So what can we see here? We can see that we have a failed breakout. You can see market open here and closed up here for the session. So this looks like this was a legitimate breakout to start a new trend. And then what we can see is the next day we opened right here and closed literally back in the balance. And you can see how for the next 2 days we were mostly staying. We did have a close to end here, so I'm not sure if this led to a imbalance, but you can see how a responsive market is what Stottlemyre called the expected behavior, that if we have a break out of value to the upside, it is considered to be expensive. Sellers are going to start selling or taking profits at these areas to secure profits, and that's going to push market back to value. If we would break down, prices are considered cheap, and we expect buyers to step in, and then this is just going to bring it back up into this area. Okay, that's the first activity type. Then the second activity is what we call initiating. This is an unexpected activity. This is when markets breaks below the value, selling is unexpected. And when market breaks above value, buying is unexpected. This happens when there is a market environment shift as perception of fair value changes, we identify it as a breakout values and acceptance as new value areas. So basically, an initiating activity is when we start a trending move, okay? And a lot of these trending moves, again, are driven by very large players that are positioning themselves, for either buying or selling really huge amounts of contracts in different markets for like the medium long term. And also, this is when we have this activity is when what we would call FOMO, fear of missing out. You've seen markets like, for example, I don't know, like a market like Bitcoin, that when it rallies really hard, where you see price pushes, consolidates, pushes, consolidates, pushes, and people are expecting pullbacks, and the pullbacks just do not come. So then people just start piling in anywhere they can, buying, trying to chase this. Well, this is all what we would call initiating activity, because basically what this is saying is, let's say in this market here, we had a balanced area here over 1, 2, 3, 4, 5, 6 days. But then on day number 6, we had this close at the top. Day 7, we open here and close up here. Day 8, we open here, close up here. So you can see how gradually now we're starting an imbalance. We're starting a trending move where buyers are stepping in and we're having higher highs, higher lows, okay? So that's what we would call initiating activities based on market profile concepts, okay? So that's pretty much it for this video, and I will see you all in the next chapter.